Welcome to Share Talk, the only podcast where investors come first.
Hello and welcome to Share Talk. Today I'm joined by Ben Habib, who's CEO at First Property. How are you today, Ben?
Very well indeed, Zach. Thank you very much.
I was interested to speak to you today because your company is into commercial property, which at the moment one would have thought it's like selling ice cream in the middle of an ice age. But how have you found the experience over recent months?
Well, as you rightly point out, we're sort of caught in the eye of the storm of this economic malaise, this sort of pandemic economic malaise. But I think, relatively speaking, First Property Group's in quite a good place. One of the slightly prescient or lucky things we did as we came up into the pandemic was to sell our largest property, which is an office block in Warsaw. And that released £17 million of cash into our balance sheet. So we've got £21 million of cash in the bank. And that's about 19p a share. So in the context of our share price, that's just over half our market cap is in cash. So as things stand, the company is very secure. And I'd also add that the sort of properties we own, whilst not being entirely economic, not entirely recessionary proof, they are recessionary resilient. And so we've got office blocks which have typically performed better than retail. And to the extent that we've got retail, it's in supermarkets and retail warehousing, which has been much less badly affected than high street retail or shopping centres. So I think, we're lucky to have quite a lot in cash, and we're lucky, I think, as far as our properties go, to be in the right part of the market. But undoubtedly, there is a big economic correction going on and a big economic drop in activity, and that's bad for tenants, that's bad for rent, that's bad for occupational levels. And so I think there is going to be pressure on capital values going forward as a result of that. But there is also perhaps an equal and opposite and perhaps even more powerful force in quantitative easing and low interest rates that will buoy values. And one of the things I'm waiting to see is, where the push and shove between economic gravity and quantitative easing sort of elevation, where that equation settles. And I don't think we'll be deploying our cash pile until we can get some clarity on where those two opposing forces settle out.
But is it fair to say that basically the pandemic hasn't lasted long enough? You weren't totally geared up before it started, so that was fortunate. And let's say with the vaccine news that we've had, we've got sort of visibility now in terms of how long this may last and how severe it might be. So therefore, it's not been as, let's say, disastrous as it could have been in the commercial sector yet.
Yeah, yet. And I think the emphasis on the word yet, because I'm not convinced that we haven't done a whole load of economic damage that is yet to be revealed. We've still got bounce back loans being offered out by the government. We've still got the Bank of England printing a lot of money. And crucially, we've still got the furlough scheme going. And that dulls a lot of the pain. I sort of feel like we're still in the phony war of 1939. We know we're at war, but bombs haven't dropped. And I think until the stimulus starts, being eased, particularly the furlough scheme, we won't really feel the economic impact. But at some point, we're going to have much higher unemployment, and we're going to have businesses genuinely going bust, and with all the domino effects that creates for banks, etc. And, without wishing to sound pessimistic, I think we've got to let that play out before we jump into the market. I think it would be an extraordinary deft sort of movement by the government and the Bank of England if they can craft a quick economic recovery from where we are, given the long time for which the economy was effectively shut down. I think it's virtually impossible to craft such a recovery.
But you, as I mentioned before, you are you do have a quite large footprint in Central Europe. Is it fair to say that they weren't quite as as foolish in terms of their strategy with the pandemic as the UK government has been?
Well, they've had a slightly different approach. The Poles, which is where most of our Central Eastern European properties in Poland, the vast majority of it is, and the Poles are much more risk tolerant than we are. Having said that, they shut down, they locked down very early. They opened up very early. They've got a younger population. They've got much lower debt to GDP at national level. So they went into the pandemic with sort of 47% government debt to GDP ratio, and I think they're emerging from it with a sort of 55-60% debt to GDP level. So, they're much healthier macroeconomically, demographically than we are. We've got an aging population in the UK. So I think it's been a much better place to invest. And of course, they're on the receiving end of very large sums of money from the European Union. And, all of that buoys their economy. So actually, Poland's been a very good place to be. In fact, Zach, Poland's been a really good place to be ever since we went there, which was 2005. They didn't go into recession in the credit crunch of 2008, and they're coming through this pandemic relatively well.
So First Property Group is sheltered from the storm. That's maybe the best analogy. And are you ready to take advantage of, let's say, coming out of the pandemic and maybe take advantage of Brexit too, which may or may not happen, obviously, still?
Yeah, well, we've got £21 million sitting in the bank, and we will deploy that together with our client money to find assets that we think are undervalued or have real growth potential coming out of the pandemic. But I think it's too early to pounce. I think we need to watch how this economic malaise plays out in the first half of 2021. And it's yet to be really proven whether I know it's got sort of all sorts of great hope pinned on it, but the vaccine may actually not do what it says on the tin. And so I think we're just going to watch the market for a bit and then probably pounce in the first half of 2021 when opportunities arise.
Right, so the vaccine could be a bit of a Chamberlain's paper fluttering in the breeze type situation.
Well, it could be. I mean, it's remarkable the speed at which they've produced it, and they've never been able to produce a vaccine for a coronavirus before. And I'm not an anti-vaxxer, and I'm not advocating, any kind of agenda here. But I just think we just got to have one eye critically on it, and not be too keen to jump onto the bandwagon of instant relief.
Right, and finally, I mean, with the current backdrop and also going forward into the new year, could it be the case that ironically there are more opportunities in the UK with distressed assets than there would be in Central Europe?
I think that's right. Actually, I think that's right. I think the difficulty our economy is going to face is going to be much greater than the Polish one. And we are looking very keenly at the UK. In a way, it's a really interesting question you asked, Zach, because normally we focused on Poland over the last sort of 13, 15 years. But we're looking very, very closely at the UK now, because I think the meltdown here is going to be bigger than in Central and Eastern Europe.
Ben Habib, CEO at First Property Group, thank you very much indeed.
Thank you very much, Zach.
Thank you for listening. Remember to visit our website for more news and other podcasts at www.share-talk.com.